No, I think when investors come in, their objective is not to give other people liquidity unless the company is already cash flow positive or closing in on that. The priority is to give the company primary capital for growth, right? So we have seen the rule of thumb being 80%, if not 100% of the round is focused on primary capital. If there is actually, by the way, if there's no excess demand in the round, so suppose somebody went to raise $10, $15 million, we got $20 million of demand. At that juncture, the founder asks, look, I don't want to dilute so much, especially if the valuation is not crazy good. Then the guy is saying, I have to take another $5 million worth of dilution at a sub $100 million price, means it's more another 5% dilution, right? At that juncture, they have, let's say, a cluttered cap table. This is a live situation as we speak in one of our companies. They have a cluttered cap table with a whole bunch of angels. The angels are willing to take liquidity also at 20-25% discount. 15 to 25% discount. So it's a win-win-win for everybody. So somebody gets partial liquidity, not at the full price, but like at a 20% discount. The company gets its, $10-15 million that it was looking for. It manages to give $5 million of liquidity, so they've parked good karma with a lot of angels. And the incoming investor has gotten a blended average price, which is a little lower than the primary price because you bought the secondary at a discount. And so this is how most secondary deal constructs work. Today, just this morning, we saw an article that, Temasek wanted to buy $150 million into Rebel Foods. So you can guess when this recording was made. So basically, if you look at that, there is surely an element of primary, which gives more runway to the company, but also probably the company recognizes that it is getting a flat round or a down round, and there is a whole bunch of investors who've been around with the company for 8-10 years, probably looking for some liquidity. Temasek senses that, gives a combination which might be weighted more in terms of secondary, but at a very good discount for themselves, whereas people who are getting liquidity know that if they pass on this opportunity, the next liquidity window might be 3 years out when the company is potentially going for a public issue. So sometimes it's about those timing issues. I don't have infinite capacity to hold, even though I might make 25% return if I held the position today. So if I've already locked in 25% return on this company, I need to show some liquidity back to my investors, I'll cash out today, whereas Temasek will then take the company forward for the next 3 years with a much higher ownership, which is coming through a combination of primary and secondary. So these are the considerations that go into secondary transactions. And as we know, the other great example in the last 6 months has been Lenskart. Doesn't need the money, close to profitability, looking to go public. It'll be one of the best sort of D2C stories in the country. $500+ million of stock is traded only on the secondary market. And rumor has it that the Dream 11 number from over 3-4 years is close to like $1 billion of secondary. So when you're a profitable company, close to public, then people who want to buy into your company for value appreciation only have a secondary mechanism to get in. So that's the holy grail of this business. Hi, this is Karthik Reddy. I'm one of the co-founding partners at Blume Ventures. Thank you for watching, and please subscribe to our YouTube channel for some wonderful content we're bringing to you.